Hello.
Hello, Prof.
Hello, Prof.
Hello, ṣé ẹ ń gbọ́ mi?
Yes, mo ń gbọ́ yín o.
In fact, this is serious. So you are logged out, right?
Bẹ́ẹ̀ ni o.
Okay. Ẹ mọ̀ pé during I couldn't log in, so it was Shima that logged in and admit me in.
Ta ló wá login báyìí?
No, èmi wá log in now.
Báwo ló ṣe wá lọ tí o kò wá lọ lọ́dọ̀ tèmi?
Ó dà pé I don't even understand because I struggle on it. Ó dà pé what you do is that èmi log in láti orí Zoom mo ti lọ log in straight.
Láti Zoom web. Zoom.
No, ibi screenshot ẹ ṣe yẹn.
Bẹ́ẹ̀.
Ẹ ti gẹ́ ẹ mọ̀ pé ẹ ṣe kan.
Bẹ́ẹ̀.
Tó máa bèèrè lọ́wọ́ yín pé log in as an host. Okay, ìbẹ̀lẹ̀ fi eléyìí sí ẹ fi password síbẹ̀.
Bẹ́ẹ̀.
Gbàtẹ́ password síbẹ̀ ẹ kẹ́ click lórí as your student has not come back. Ó yẹ kẹ́ click lórí sign in with Google.
Nǹkan mo click lórí náà nìyẹn, ó ń gbé mi lọ sí ibòmíì. Màá mú débẹ̀ yẹn náà, yẹn náà sign in. Ó ń gbé mi, ó open another kíní fún mi ni entirely.
May foundation yẹn lórí Gmail yín lórí system yín tó yẹ kí system lẹ́ ń lò àbí phone tẹ́ẹ̀tì open ẹ̀ tẹ́lẹ̀. you won't be able
Yeah.
to access it.
Okay.
So
System
that's
on.
what happened. If you have not accessed that particular email, you won't be able to access it. You
Okay.
won't be able to sign in.
Tí bá ti ṣe email yẹn gangan lórí fóònù mi lè sign in.
Lórí device tẹ̀fẹ́ yes
Oh,
Google tí ní recognize you have access to that email.
okay.
So student pè yín.
Ó pè mí o. Former student mi gan ni na old student mi ni.
I know àti kọrí náà.
Ẹ tó kọ rí.
Àti kọrí mo ṣe rí. Àti kọrí.
Ó ń dùn mí o.
Thank God that I went to go and join Adesua. Adesua's phone went off. Battery went off. Parata signing as an host. So because he has made me co-host, so I was automatically converted.
Ebi kọta sọ ni ẹ pé kíyàn máa jẹ host kí ló mi jẹ co-host.
So nǹkan tó ṣe nìyẹn.
Okay.
Tó ẹ pé ní ìpè ẹ̀yìn ẹ̀ ní co-host. Nǹkan tó
ṣẹlẹ̀ náà nìyẹn tó fi off pàpàtà.
Yeah, ní co-host. In fact, tó ẹ pé mi sí lọ́dọ̀ Adesua nígbà tí fóònù ẹ̀ went off mi, she won't be able to enter again.
Pàtàkì. Àwọn ọmọ mi ò tí sùn ni. Bí yín gbọ́ dáàdì.
Yàrá wọn mo lọ, yàrá wọn mo wá sí.
Okay. Ẹ jẹ́ kó sùn.
Wọ́n wo cartoon sùn tẹ̀ by this time.
Wow.
I can't sleep by this time.
Hello, Mr. Kende. Yeah, Mr. Can you come back online? Yeah, please. The line is okay now. Yeah. Okay, mo ti pè. Táwa ní post fún Adesua báyìí.
Nobody is there now.
Kí ni Prof Saliu ńkọ́? Ṣé Prof Saliu lè jẹ́ co-host níbo ló lọ?
Wọ́n lọ jẹun, wọ́n lọ tí irun àwẹ̀.
Láti fún 1 hour pé ẹ̀kọ́ ìwọ̀n ti parí ẹ̀ náà.
Nobody is with Adesua now.
So, enable mi láti share screen.
Okay, yeah, yes. Okay, Kẹ́hìndé ti dé gan padà.
Get the admitted.
Yeah, we ti admitted, but Oshin still coming. Kò tí
Ẹ lè pa fídíò ẹ̀ gan. Ẹ gbọ́?
fídíò ẹ̀ kí ló yẹ tó why ìdẹ́ fi ń allow ẹ̀ kó máa lo fídíò?
Ẹ lẹ́ máa pa.
No, okay. That time I couldn't do it. Ẹ mọ̀ pé mi kì í ṣe host mi, kì í ṣe co-host, so I couldn't do it.
Okay.
But I will do it now. To back
Oh yeah, it's coming in with 2 phones. Are we good to go? Mr. Kenny. Mr. Kenny, can you hear me? Mr. Kenny, can you hear me?
Yeah.
Okay, so please. Yeah, sorry about the network the other time.
No problem, sir.
So let's see what we can capture for the few minutes that we have left. Apologies about that.
Okay.
Yeah.
No problem, sir. Apologies.
Okay, sir. So we stop at partnership where we talked about the 2 people to 20 people coming together. They have the same interest at to do business. So they can come together to actually form a partnership, to form business. And their major purpose, the end goal is to make profit. And we look into the advantages that we talk about, the what we call the knowledge capital. We talk about the decisions. There's a wide range of decisions. We talk about that the continuity of the business actually what is higher than the sole proprietorship own. Also, the other advantage also is that what there are ideas. There are a lot of ideas into the business compared to sole proprietorship. Expertise are being brought on board to what is sole proprietorship. But the aftermath of it is that disadvantage is that distrust and disagreement among partnership. It can lead to the end of the world of the business. When the partner A does not trust partner B, it actually what it affects the movement and the growth of the business. Another one that we have is also what we call unlimited liability. Like I said, also they are unlimited liability in the sense that when 2 partners actually what if they have issues with debts, with fulfilling their debt obligation, their creditors can go as far as also selling their what their private or property to recover back their debt. That's why they are unlimited to the capital they are what they have invested into the business. Another one that we have is what disadvantage is slow decision. Slow decision in the sense that if we have 5 partners, the 5 partner must be aware before the decision is made. And whenever they are going to partner A, partner B, partner C, having different opinions on a particular issue, it means that what there will be slow, or the decision making process will be very slow. Another one also is what difficulty of termination. Difficulty of termination is that it's not easy to let go of partner A or partner B. They have what we call deal of partnership. Deal of partnership is what they use to tell you what that governs the way they behave. It governs the way how things are being run in the partnership organization. The third type of business that we have is company. We say we have the proprietorship, partnership, and the third one we have a company. Now, a company is actually what a legal person without physical existence is what an entity, a separate entity. In the face of law is regarded as what as a living human being. So a company is a legal person without physical existence, recognized by the law to do business for profit through its agent and servant who exist physically. Are you with me, sir?
Yeah, I'm with you.
Okay, so that a company, now a company says that okay, we have chairman, we have shareholders A and B. Shareholders A and B are there. Fine, that's good. But if anything happened to the company, like we have the company is C, let's say company A and B Limited. Now, anything that happened, that A and B Limited is seen as a person in the presence of law. It means that that company can be sued and sue. It means that someone can take that company to court. Now, if anybody is taking that company to court, they are not taking the owner of the company to court. They are taking the company to court. So it seems like a what, like a living person in in the presence of the law. So that's why we say, and we have different type of what company and company for the ownership to claim ownership of that company, it must have what evidence of shares, evidence of what of shares. Whenever so shares is actually used to show the ownership or the percentage of ownership in a company. So shares are actually what used by percentage. You have 100%. 100% means that what totality this is the owner of the what of the business 100%. While some people have like maybe 20%, maybe 30%, maybe 40%. And this actually percentage is actually very important when you move to skills level. you'll be talking about the under skills level, you'll be talking something about the group accounts, which means that those people that have like 50% of the shareholder can be regarded as what, as the more than 50% can be regarded as the parent company, but anything less than 50% cannot be regarded as parent company, can be regarded as what, no minority interest. So it depends. When you get to the skill level, you get that better. So let's move into the further one. Now we are talking about the course here that we are talking about is Introduction to Financial Accounting. So let us now talk about accounting. What do you understand by accounting in itself? Now, accounting is actually a system. It's a system. And you know, when you talk about a system means what, different activities that were brought together to achieve a particular goal. So it means that what, different activities, different models that's actually what brought together for a one single purpose. And that's why we call accounting is a system meant for measuring business activities, processes of what, information into reports and making the system available to decision makers. That's what we call accounting, the system. Now, the system in the sense that number one, the approver, the person that collected the money. Number two, what they're using for, raising of vouchers. Number three, posting of that vouchers. Number four, assessing the voucher, interpreting the vouchers, and also they'll just make the information available for the financial users. So that's what the accounting. Why bookkeeping is actually what is a systematic recording and organizing of financial transaction in a company. Now, bookkeeping does not require you to know to have good understanding about debit, credit, and debit and rules. No, but the bookkeeping is all about what, systematic recording. Now, anybody can record. It's all about just recording the activities that have happened, filing it in an organized manner, organized manner. So that's what we call bookkeeping. Now, there's a difference between accounting and bookkeeping. Now, bookkeeping is your mechanism that is used to you just record what in a transaction. But accounting goes beyond bookkeeping. Accounting now interprets, it analyzes the information that has been provided by the bookkeepers. It analyzes it, it prepares it in a way that will be useful for the financial users so that they can use it to make decisions. So that is, so a bookkeeper stops at just recording transaction and organizing it. But an accountant actually would go ahead and will bring out the information and not transform it that will not be useful for the financial users. That's why they say accounting now includes, let's say the word accounting, it includes bookkeeping. Because if we look at the under definition of accounting also what is thematically what recording, classifying, analyzing, and communicating financial information to the users so that they can make what economical decision from it. So it means that the recording and the classifying part also is what is included inside the what inside accounting. Now, let's talk about what we don't understand by financial accounting. Now, before we move to financial accounting on its own have a wide area, a wide scope. That's what we call a financial accountant. That's what we call costing accountant. That's what we call management accountant. There's other people called auditors. We have the tax people, the tax consultant. We have the forensic auditors. We have a lot of field under accounting. But this course is talking about financial accounting, which means the financial accountant. Now, financial accounting, these are the people that are responsible for the preparation of financial statement. They are responsible for preparation of financial statement. That's the financial accounting. Whenever you hear the word financial accounting, it means that they are responsible for the preparation of financial statement. Now, the financial accountant. Now, the accountant there is a noun. So that means what it brings in what is actually a noun. That's why we call it that word. They are responsible for the preparation of financial statement. But now let's not talk into an action word, which is the word a verb. We're not talking about financial accounting. It's actually what is the process. Financial accounting actually what is the process that understudy the preparation of financial statement for the basic purpose of providing information to its user. That's what financial accounting is all about. So it's a process. It's like what is a process that understudy the preparation of financial statements. Now, financial statement can actually what we have a different reason why we prepare our financial statement, and it's prepared based on what different concepts, convention, principles, and rules, and that's what we call this convention, concept, the rules and principles that's brought together is what we regard as general accepted accounting principles. It means that these are the general rules or guidelines that be accepted by the profession in use to what to prepare the financial statements. Now, so we have different type of what the concept. Example, I was talk about the dual asset concept, the going concern concept. The going concern concept talks about that the business will be in what in being in existence for foreseeable future. We have the one that called dual asset concept. Dual asset concept means that every transaction have two legs. We have the credit and debit. There's a receiver and there's a giver. We have another concept talk about the matching concept. A matching concept means that you match the revenue against the expenses. That's matching concept all about. So these are the what? These are the concept. These are the ideology that is used in preparing the financial statement. Now, what is the objective? So let's just mention some of the objective of what of accounting. Now, the one of the objective of accounting is what thematic record. It actually assists us to what to record our information in a schematic manner so that it can be easily retrieved and also what be easily what accessible so that it can be transferred into information. And also is to ascertain the profitability level of a business. Because at the end of the month or at the end of the week or at the end of the year, the businessman wants to know how his resources have increased over time. So accounting also helps us to ascertain the amount of profit that have been derived over particular period of time. Another one also that is for decision making as well. Accounting also is used for decision making in the sense that when information is being prepared, before you can make decision, you need some particular information. You need to know where you are coming from, you need to know where you are, and you need to know where you are going to. So the information, you need this information to make decisions so that you'll be able to account or you're able to predict what is obtainable in the future time. So an accounting provides this information in form of what presenting the financial statement to the user. Another one also is what to fulfill the compliance with the law, because based by the law, it's expected that all companies must prepare their financial statement and must be audited. Now, in order for them to actually be audited and for tax purpose as well, compliance, because how will government know the amount to that is due for them to pay? It means that they need information, and this information is a form of financial statement that they now rely on to compute. So to compute the tax that is payable by the company. Then lastly, also to ascertain financial position of the business. To ascertain the financial position is that to know the liability, which means the debt that the business actually incur at that particular point in time, and also to state the asset that they have. Now to check again if the liability is more than the asset, to state if the business is actually doing well, if the business is growing or not. Because for example, now if your net asset for this period is 20,000, for next period the net asset now will increase from 20,000 to 30,000. It means that at that moment your financial position is reasonable. But you can't just rely on that alone. You still have to go further. You have to do further analysis before you can conclude on your results and before you can make the decision. Now, in absence or when you're done with that, please you need to know this because they can ask you some simple questions like this. What are the objectives or what are the advantages of accounting? What is the purpose? Why are we even doing? What is the reason why accounting is actually important and mandatory for us to know? So they can ask you that, and when I ask you that, just give them these 5 points and you are good to go. Now, let's move to the next point, which is what? Accounting process. Now, I will try to explain this accounting process in details for you to understand. But I believe that if you are able to understand this accounting process, it will assist you a lot in this course, because everything that you're going to be doing in this course kind of is around this accounting process. Everything you'll be doing is around this accounting process. Now let's go to the first one. The first stage in accounting process, which might mean that the process to prepare the financial statement. Accounting process I'm talking about is what? Is the process for preparation of what? Financial statement. You remember I talked about what financial accounting is what is the study of outflow of financial statement that have been prepared. Now, what are the processes? What are the steps that we take to prepare the financial statement? The first one is what? Collecting and analyzing what? Accounting documents. You collect and you analyze accounting documents. This actually what is a form of like bookkeeping. It means that what you obtain information and you analyze them. So when you collect information, what do you do? You record them. You are doing the bookkeeping. You record them and you organize them. And when you organize them, it means that you are analyzing them into various subsections that will be identified. Now, for example, what are the example of documents that you are collecting? You are collecting documents like vouchers. You are collecting documents like receipts. You are collecting documents like pay-in slip. You are collecting documents. You are collecting supporting documents. These are the documents that you collect before you can now prepare your financial statement, because these documents have the information on them that you need. They have the quantity of item purchased. They have the type of item purchased. They also have what we call the amount of the item. They have a different information that you need to prepare to use. Then after you have those information, the second thing is now what? You now post in journal. Now, journal is actually what? Is a document that shows the two leg of the transaction. It shows the debit credit of a particular transaction. That's journal. So when you now have it, okay, this is a voucher. I have a voucher. The voucher shows that okay, I purchased a motor vehicle. Then after you have noted that okay, this voucher shows that I've purchased a motor vehicle and there's a receipt about attached to it, then you now go to your journal. Which account should I debit? Which account should I credit? You show it there. Then after you have showed it there, the next thing is now for you to now post into ledger. You post into ledgers. Ledgers are what? Ledgers are just a prime books of account. They are the what? They are the principal books of account in which the from the journal you post to your ledger. Let's say example, I receive a voucher. I purchased a motor vehicle. Okay, I purchased a motor vehicle. In my journal, I'll now say, okay, which account should I debit? Which account should I credit? Now, I'll still explain this in details. I'm just trying to brief it for you so that you understand the process. So, for example, okay, I've noticed that now, okay, I purchase. Then that what I have a receiver and a giver. Now, there's a receiver, there's a giver. When I purchase with cash, it means that my cash is given and my motor vehicle is what is receiving. And the rule says that what? Credit the giver and debit the what? The receiver. Now, if my cash is given, it means that what? I will credit my cash. Then if my what? My motor vehicle is receiving, it means that what? I will debit my motor vehicle. So it means that what? I've passed the journal on it. Then I'll now come to the ledger. Ledger is what, like I said, is the principal book of account. Then under ledger, example of ledger, we have the cash account, we have what we call the motor vehicle account, we have what we call the salary account. These are type of ledgers. So after that, I'll now post under my cash account, I'll now credit the amount of the motor vehicle. Then I'll go to motor vehicle account. I'll now debit the amount that the cost of the motor vehicle. I'll put it there. When I'm done with it, other transactions also will be done there. Then I'll sum it, I'll add it up together. The balance is what I'm going to take to my next step, which is regarded as what? Trial balance. Trial balance is actually the what? is a document that shows the accuracy of what? Of my ledgers. It shows the accuracy of my of my balance ledger. It means that if I actually do things right, my trial balance, which means the debit side and the credit side, should balance. That's what trial balance is talking about. That my my left hand side and my right hand side must be the same thing. Now, if they are not the same thing, it means I've done wrong posting. Now, let's assume now they are the same thing. So my credit side and my debit side, they are the same. They are giving me the same figure. Then I will now need to to now adjust. The next step now say posting of adjustment entries. Adjustment entries that I'm talking about is just like number example is depreciation. The asset that you have used over time, you raise an adjustment on it. And that one for that you raise an adjustment for it. When you have raised adjustment, you will now get what we call adjusted trial balance. Please, all this will be explained in details as we go in the course. So we now raise what we call adjustment trial balance. The difference between the initial trial balance and the adjusted trial balance is the adjustment entries that we have done in between. Now, is that if there is no adjustment entries, the initial trial balance will be the same thing with with the adjustment trial balance. Now, once we are done with that, it's from our trial balance that we now prepare our financial statement. So, is the balances of each ledgers that will be identified in our trial balance that will now be posted to our financial statement. Then after that, we now the balances of the financial position will now be taken to the following year. That's why we now have posting, closing, post, closing trial balance. As we go further, I will explain that in details. Now we have been mentioning a lot of things about financial statement, financial statement, financial statement. Even what do you understand by financial statement? Because we have mentioned we have mentioned financial statement times with that number. So what do I understand by financial statement? We look at the word, a statement. A statement is actually the word, a record. Is a document that the word that shows information, that give us more information to a particular transaction. But when you're talking about financials, financial is talking about what? The resources. It's talking about money. That's financials. Now let's join these two together. You're talking about financial statement. Now, financial statement are written records that convey the financial activities and condition of a business or entity. Statement. Financial statement shows the transaction that have occurred in a particular period. It also shows the condition of the business in its present state. That's financial statement all about. Now, financial statement shows that it means that when you pick up a financial statement, you'll be able to ascertain what they have done for a particular period of time. It means that you'll be able to ascertain that if profits have been made or not. To be able to ascertain if the business have grown or not. Now, financial statement relates to what we call a given period. They relate to a particular given period. It's prepared within a given period. Now, it's normally prepared within 12 months. And the 12 months can be from 1 month to any month. It can be from June to from June to May. It can be from July to June. Once it's closed out 12 months, you are good to go. For government, it's always from January to December. Now, that 12 months have a name. And the name of that 12 months is what we call financial year or accounting period or reporting period. It means that your financial statement will be prepared over what we call a financial year, which is 12 months. And like I said, your 12 months is not compulsory from the January to December. It can be from let's say from June to May, or from July to June, or from November to October. But the major goal is that it must be 12 months. And I said that the name of the 12 months is regarded as financial year, and that name is accounting period, and that period. So the three names can be what? Can be used independently. Now, financial statements. Financial statement comprises of some informations. Financial statement comprises of some informations. Are we there? Is that where we are? Okay, I think we are not there yet. Okay, let me just explain that since I've mentioned it. Okay, financial statement comprises of some information. It's comprised of some documents. And some of the documents what regarded as number one, statement of what we call financial performance. We have statement of what we call let me say, okay, now we have it here. So we have the statement of financial position. Statement of financial position is also what we formerly know as balance sheet. So it is the document that shows the assets, the liability, and the equity of the company. Then we also have what we call the statement of profit or loss and another comprehensive income. Is actually another name for it is income statement. It shows the performance of the organization for a particular period of time. Then we have a statement of changes in equity. Statement of changes in equity means that there are the capital in the beginning. Is not if there's any change in it compared to the capital at the closing, we have to show it. For example, it can be maybe reserve, there's payout from the reserve. It means that we have to reduce it. So the major reason why we prepare the statement is to show the movement in this reserve. And that we have is a statement of cash flow. A statement of cash flow, the reason why we prepare statement of cash flow is to be able to trace where cash is coming from and where cash to record it inflow and outflow. Then we have three activities under statement of cash flow. We have what we call the operating activities. We have what we call the financing activities. We have what we call investing activities. Now, apart from that, also we have what we call note to the financial statement. Now, note to financial statement is a document that supports, that provide additional information to the figures that have been included under the financial statement. So if your financial statement, such as statement of performance or loss, is actually a summary of the activities. But in order for you to now know more about the figures, then you now go to note to the financial statement. Now, note to the financial statement also gives some principles that have been adopted by the organization and what we call the accounting policies. The accounting policies shows about, because we have a lot of principles in accounting. So accounting policy shows the principles that the organization have adopted, the organization have agreed to use over time. Now, accounting information, we have two users. The users of accounting information, which is financial statement, can be divided into two. We have the external users and we have we have the internal users. Now, the external users are those that are not they are not involved in the running of the business. They are not involved in day-to-day activities. That's the external users. An example of them are actually the investors, people that have committed their money into the business. Another example also is the directors. The directors are the people that are not the owners. They are not involved in the day-to-day activities, but they need them to they need to know how the business is performing. Another one also the customer. The customer also is another external user of the financial statement. You want to know if the company can still sustain him or her for a reasonable period of time. Then we have supplier. Supplier want to know, the reason why supplier needs the accounting information, we don't want to know if the business is liquid enough to fulfill their obligation when it's due, which means that when they expect to pay them in 1 month time, they'll have the ability to pay so that they can also be in business. Another example of external user is the regulators. These are the tax people. They want to know the amount that is due to the government. that the government needs to what, to collect from the business so that they can what, they can use it to run the economy. So we have different type of users, and every user have different purpose why they are what, why they are interested in the accounting information. Now another set of users that we have is what, is the internal users. The internal users are actually, or what we call, those that are involved in the what, in the big operation. And we have them with what, with the managerial accounting. Example of these people are what, are the procurement manager. The procurement manager want to know they want to know how liquid the business is, so that they can plan, they can schedule their planning when to work, when to procure items. They want to know if the business have the that they will need for the next month, or for in 2 months' time. And if the business does not have the money, they can what, they can know what they can do scale of priority, know what and what to cut down, and what to purchase. The HR also need it as well. The HR needs to know how their staff is being productive. They want to know if the staff is productive. They want to know if the given business is growing, so that they can also ask for increment on some allowance for the staff. Then we have the production manager also want to know the sales of last month to this month, to know if they're actually selling. The marketing manager also want to know if the KPI that have been mentioned is actually being in line. So a lot of them have different reasons why they need the accounting information. So the reasons is what drive them to what? To need the information. And that's why the accountant now need to prepare an information that will be what? That will be universal. An information that will be acceptable. Because the external people cannot walk up to the accountant and say, okay, I need this information, I need this financial statement because of this information. No. And that person also will now work, I need the financial statement because it will be too much work on the accountant. That is one of the major reasons why we have what we call gap. That's one of the reasons why we have gap. And gap, like I say, is what? Is the general accepted accounting principles. And that will take us to a brief of these regulations of financial reporting. So I will brief this because this is actually what is like a topic on its own in the next chapter. So reporting of financial reporting. Now, regulation of financial reporting. Regulation of financial reporting. We are talking about, accounting. Accounting is actually universal. Accounting is not restricted to a country. It's actually what is over the shore of a country. So we need to actually accept. There must be universal acceptance of a standard, and that's where we now say GAAP is actually what? Generally accepted accounting principles. Then it's actually what talk about the accepted concepts, conventions, rules, the principles that have been accepted generally in use to prepare the financial statement. It means that if I should prepare a financial statement in Nigeria, if they prepare another financial statement in another country, give or take to some reasonable extent, the principles, the basis in which the financial statements are being prepared must be the same. It means it must what? It must be reasonable what? Acceptable. Which means that if another country and another person in another country, let's say Ghana, take a financial statement that's prepared in Nigeria, that financial statement should be usable by him. It should be able to determine, or it should be able to make economic decision with that financial statement. That's why we call it generally accepted. Now, that encompasses concepts, principles, conventions, laws, rules, and regulations that are used to prepare and present financial statements. GAAP aims to make information in financial statements relevant, reliable, and what? Comparable. The major purpose for GAAP is what? Is to make the information relevant. Number two, to make it reliable, because there are some standards that have been set up. So if that standard is being followed, then people can rely on information. Then lastly is what? Is to be comparable, which means that my report, my financial statement in Nigeria can be compared to the financial statement in another country. Now, GAAP actually have what we call the qualitative aspect of it, called characteristic. And the qualitative characteristic is actually what? We'll talk about it more later. We have the fundamental ones. And fundamental ones are what we call what? The relevant, that every information, every data that being posted, that is included or added to financial statement must be relevant. And also it must what? It must be faithfully represented. Then we now have other enhancements, other qualitative enhancements. We talk about what? The comparability, we talk about the timeliness, we talk about the variability, we talk about the understandability. These are the what? These are the other enhancement quality that we have there. Talk about data more. Now, GAAP have we have two sources of GAAP. We have one from the company law and from the what? The accounting standard. Now, the company law we are talking about is the country law. It means that the law that be established by the country. So we have the country law and we have the accounting standard. The accounting standard is the law, is the principles that have been released by the board, by the accounting board, to be used to prepare the financial statement. So there are the reasons. That's why I said the reason why, if you follow me carefully, I said that to some reasonable extent, the financial statement prepared in another country should be able to what? To be compared or used in what? Compared to prepare in Nigeria. I didn't say 100%, I say reasonably. The reason why I say reasonably is because the gap that we're talking about comprises of two sources: the company law, the country law, and the accounting standard. Now, the country law varies. Our law in Nigeria varies when compared to the law in Ghana. So, which means that what is acceptable in Nigeria might not be acceptable in Ghana. Now, if that happens, it means that the way the transaction will be treated in Nigeria will be different from the way that such transaction will be treated in Ghana. So that's why I said that was reasonably is what? There's a little difference there. But whenever any financial statement say to follow the standard say that they must disclose it under the note to the financial statement. They have to be disclosed that they have actually what? Move away from the principles. And when we're talking about the accounting standard, we're talking about the IFRS, that International Financial Reporting Standard. We're talking about the IAS. We're talking about the one IAS 1 presentation of what? Preparation and presentation of financial statement. We're talking about the IAS 16. We talk about the property, plant, and equipment. We are talking about different, like cash flow statement and the rest. So whenever there's a difference like that, they have to disclose it, that they have moved away from this stand because their law abides to this, because their law actually state that this standard is what they should follow. Now let's just stop on that gap there, and when we move further, when we move to the next topic, I actually want to explain that in detail. Let's talk about the basis of accounting. Basis of accounting is all about the platform. I mean the platform that will prepare the financial statement. It means that what is the ideology in preparing the financial statement. Now, we have three bases of preparing financial statement. We have three. Well, number one, we have what we call the accrual basis. Number two, we have what we call the cash basis. Then number three, we have what we call the break-up basis. These are the three bases that is used to prepare financial statement in private sector. I repeat, these are the three bases that can be used to prepare the financial statement under private sector. Now, accounting basis. Accounting basis is talking about the process or a situation where transactions are recognized. When I say when transactions are recognized, I mean when transactions are documented in financial statement. So it means accurate basis accounting recognize transaction and other events and circumstances in a period in which those effects occur, even if the resulting cash receipts and payment occur in a different period. What we are saying here is this, that accurate basis does not wait until you receive cash. Accurate basis records transaction once there's evidence that the transaction have occurred. Example, I purchase, for example, I purchased an iPhone on credit. I've not paid for the iPhone, but I've collected the iPhone and I've promised the person that I'm going to pay the person in the next 1 month, and we have agreed. And there's a document to show for that. Now, what they're saying that transactions have actually occurred, even though there have not been cash receipt or cash payment. Such transaction must be recognized in our financial statement. That's what the accurate basis are talking about. That such transaction must be recognized in our financial statements. You understand it better as we move on. Now let's look at the second one, which is what? Cash basis. Now, this cash basis is actually what? Opposite of accurate basis. Now, cash basis accounting recognize transaction in the period in which cash receipt and payments occur. In which cash receipt and payment occur. So we are talking about now cash. It means that, for example, now the example I gave earlier, I purchased a phone in the month of February. I didn't pay for that money in that month of February. We agreed that I will pay for that month. I'll pay for that iPhone in the month of June. Accurate basis say that I will recognize it in my financial statement. But I will recognize in my financial statement that transaction occurred in the month of February. But under cash basis, the transaction occurred in the month of February, but I'm not going to recognize it. It's not going to enter my book in that month that I received the amount. What will happen is that I will record it in my financial statement when I pay for that iPhone. And the payment of that iPhone is expected to be in June. So in the month of June, when I pay for the iPhone, I will now record that I purchased an iPhone in the month of June. That's cash basis. I would say cash basis record transaction when cash is received, not when cash is earned, when cash is received. Now, the not break it down, so I cannot frame it up like say that what cash basis record the revenue when they are received and not when they are earned. And a record expenditure when they are incurred and not when they make payment and not when they are incurred. That's what cash basis. Then we now look at the breakup basis. Now, breakup basis is talking about that business that we have established is not going to work. It's not going to be in continuity in the next future. It means that this business that we have established is going to fold up in the next particular period of time. Now, the earlier basis that we have mentioned, which is the accrual basis and the cash basis, they assume that the business will be existing for the next futurable period. But break up, it means that this business will no longer be in existence again after a particular period of time. So it means that the business are folded up. So when the business product, it means we have to use what the break up basis to record the transaction that will happen within the what break up period. Now let's take an example to actually explain the accrual basis and the cash basis that I explained earlier. Now let's look at example 1. Example 1 says, okay, I'm ready. Example 1 says that a company prepares its financial statement to the 31st December each year. So it means that what? Their reporting period. It means that their reporting period is from January to December because they prepare it at the end of 31st December each year. So it means that period is what? They are January to December. And January to December is giving us 12 months. And 12 months is what? Reporting period or financial year. Now, or accounting period. Let's continue. It sells goods for 100,000 to a customer on 25th December year 3. We normally close our financial year every December. And it now makes sales of 100,000 in 25th December, that's Christmas Day, but does not receive a cash payment from the customer. The customer did not pay on that day until 1st February year 4, which means the customer pays for the transaction that occurred in year 3. He pays in February in year 4. Now, what will be the treatment under accrual and cash? Now, the treatment is this. So the solution is there. Solution. Under accrual basis, the transaction will be recorded in year 3, even though no payment has been received. Can you see that? Accrual basis, there's an evidence that I've made sales, but I've not received cash, but I will record it. That I've actually I've carried out a particular transaction. Then I will now have what we call trade receivables. Trade receivables means that I'm expecting the customer to pay me a particular sum of amount, but it will show in my financial statement at the end of year 3. But if I'm using cash basis, at the end of year 3, that transaction will not show in my financial statement. I will only note it down that I've given out an inventory. I'm here to collect money, but it won't come under my financial statement. So it means that under cash basis, if you pick a financial statement under cash basis, you need to add for additional information for you to actually know if the revenue is actually new, if the inventory is actually the inventory at the closing period. Now, at the under cash basis, the transaction will be recorded in year 4. That's the February. So it will not be assumed that the sales was made in the month of February in year 4, when the cash payment was received, even though the transaction occurred in year 3. Now let's look at question 2. A company starts in business on 1st August year 1. So August year 1, that's where they start business. It acquires an office for which it pays 1 year rent in advance. So it pays 1 year rent in advance. It means they have not enjoyed the rent, so it pays in advance. And the year will end. The rent will end in 31st July year 2. So which means year 1, year 2. So it lapses from year 1 to year 2. Now, if it ends in 31st July year 2, now if you count it 12 months backward, it means that the rent will start reading in the month of June. Are you with me? So it means that it will start reading in the month of June, year 1. So if we count from June now, we now see June, July, August, September, October, November, December, January, February, March, April, May. Sorry, July. If it starts 1st July, then it means that, okay, 1st July. If you count forward, that's June. Okay, is it June? No, that should not be June. Okay, let's come backward. Let's come backward. Let's get it backward. So we have July. We have to count July as part of the month. We have July number one. We have June. We have May. We have April. We have April. After April, we have March. We have February. We have January. That's what. That's why. After that, we have December, November, October, September. September. What do you have after September? June. So it means that 12 months, you can't 12 months backward. So now if it ends in July, then probably that should be what it should start from June to the other one. Now the cost. Just give me a minute here, please. To calculate it backward. Give me a minute here, please. So we have July, we have June. After July, we have June. After June, we have okay. It starts in August. Thank you. I've gotten it. August. I miss August then. So if we start from August, we have August, September, October, November, December, January, February, March, April, May, June, July. So it starts from the month of what? August. So if we start from the month of August, then it means that in year one, you only use what? How many months? You only use August, September, October, November. You only use 4 months. You only use 4 months. Now the cost of annual rent is 200,000. So the total cost for the 12 months is 200,000, but you only use 4 months in the year one. The company prepares its financial statement for financial period ending 31st December each year. What will be the treatment under accrual and cash basis? Now, under the accrual basis, it means that the amount that he actually used, it should be one that we are going to recognize. That's under accrual basis. Now, under accrual basis, we now say, okay, under accrual, the amount of rent that will be recorded in year one will be, this figure is wrong, please. This figure is wrong. It should not be 116,667. The figure should be, like, if you look at the calculator, it should be 4. If you look at the calculator, let's put our calculator out. It will be 4 divided, that's 4 months. You use 4 months in the year one. That's August, September, October, November. August, September, October, November, December. 5 months rather. Sorry, please. 5 months. 5 months, please. So you use 5 months in year one. Now, 5 divided by 12. 5 divided by 12 times 200,000. That will give us 8333. So which means the actual amount that we recognize in year one is 83,333. And the which is 7 months will now be 116,667. Will now be recognized in year two. Please, that figure we need to interchange. You need to change it to each other, please.
Okay.
So you need to just change to each other, please. So year one should be 83,333, while year two should be 116,767.
Okay.
Are you with me, sir?
Yes, I'm with you.
Okay, yeah, please, you need to, and the reason is that accrual basis. Now, the two of them will be recognized, though. Please get me. Accrual basis that what the total amount, as long as there's a proof that transaction have occurred. So it means that in year one, in your expenses, you are going to show 83,333. But under your current assets, you are going to show 116,667. It means that you have not consumed that part of the rent, but you have showed it. So in year two, you will not show that amount there. But under cash basis, you are going to show the whole 200,000 in year one as against the accrual basis. So it means that year one, it means that you have what? They assume that you have consumed all the rent in year one, which is not so. So that's the major difference between accrual basis and cash basis. But the one that is majorly used in the business environment is the accrual basis. Accrual basis is the one that is widely used because it's actually what is give more information and it explains it explains, it shows the position of each item at a particular point in time. So because of our time, and I would like to stop here. But before we call it a day, I first want to apologize for the network issue that occurred earlier at the beginning of the class. I'll say we are very sorry about that. We'll try as much as possible to rectify that and to prevent that from occurring again. Before we call it a day also, Mr. Kennedy, I want to know if you have any question for what I've done. Please, I don't want you to be discouraged. I know it's elementary, but I just want us to
No.
yeah, I just want us to be rooted in it before gradually as we improve, yeah, our speed will also increase. So that's why I'm taking in our time to get it. So do you have any question before we call it a day, sir?
No questions. Everything is well understood. But
Okay.
in case maybe in the course of going through the what's it called, the
Material.
what I've learned today. So if I come across any gray area, then maybe I can call you personally.
Yes, sir, you can call me, sir.
Info that.
And again,
Yes.
the number that you call me on is also my WhatsApp number. Anytime, sir, just send it to me. I will respond to you as soon as possible.
Okay.
Okay.
Thank you very much.
Yeah, thank you very much, sir. Thank you for your time.
You're welcome,
And
sir.
do enjoy the night rest, sir.
Same. Thank you, sir.
Yeah,
Yeah.
welcome.
Bye,
Yeah,
sir.
bye, sir.
Thank you.
Well done.
Yes, Prof. Prof. Oh, hello, Prof. Hello,
Hello,
Prof.
Prof.
Yes, sir.
Well done. No.
Yeah, thank you very much, sir.
Kú iṣẹ́ o.
Yes, sir. Okay. Prof, mo dẹ̀ ń ro kíní kan sí o.
Okay.
Ẹgbẹ́ mi ò parí material yẹn, ó kú second topic.
Yes.
Ẹ máa ṣe ẹ lè pick it up láti bẹ̀.
Yeah. Náà ibi tẹ́ parẹ́ sí yẹn. I know.
Okay, Prof.
Bóyá kẹ́ share pẹ̀lú mi.
Ma'am, sure, máa share pẹ̀lú yín. Every material, mo gbàgbé gan láti include yín ní. Henceforth, every material máa share pẹ̀lú yín.
Ẹ máa share pẹ̀lú mi.
Yes, sir.
So that
Okay.
kò ní jẹ́ pé new thing la bẹ̀rẹ̀ without finishing this one.
Exactly. So that I'm on the same page, woman understand better.
Yeah. That's
Okay.
And the guy actually told me.
Okay, báwo ni class, sir?
Yeah, it was okay. In fact, even me too, I enjoyed it.
Okay, sir. Thank God for that, sir.
Yeah, it was okay.
Okay.
Kudos. Ẹ jẹ́ ká lọ join wọn ní director's meeting, wọ́n ti ń chat.
Okay, sir.
All right. Let me end the class.